I've been watching the screens for the last 48 hours and the market sentiment feels like a total frenzy. Headlines are hitting the wires that a US-Iran ceasefire is finally on the table. It is not just a rumor anymore. It is being treated as a near certainty, and the immediate reaction from the crowd has been to dump everything that smells like a defensive asset, especially gold. People are shouting that the war is over, the safe haven demand is dead, and it is time to run for the exit. But I am sitting here looking at the charts and the fundamental data, and I cannot help but feel that most people are walking directly into a lethal trap. If your instinct is to panic, sell your gold right now. You are literally handing your hard-earned chips to the smart money on a silver platter. And the timing here could not be more critical. We have the PCE inflation data coming out this Thursday, and we have this historic negotiation reaching its final sprint. When you combine these two massive events in 1 week, you get a volatility window that we have not seen in months. So today I want to strip away all the emotional noise. I want to stop talking about fear, and I want to dive into the raw mechanics of how markets actually price gold. Because there are three fundamental questions we need to answer. First, why has gold been acting like a dead asset for the last 3 months, despite all the geopolitical chaos and debt drama? Second, is a ceasefire actually bad for gold, or is it a massive hidden opportunity that everyone is ignoring? And third, what is this PCE data going to do to your portfolio, and how should you prepare for it? Let us start by addressing the elephant in the room. Gold has felt like a graveyard for weeks. Every time it tries to rally, it gets slammed back down, and investors are frustrated. They look at the Middle East, they look at the debt, and they wonder why their hedge is not working. Well, the answer is not because of sentiment, it is because of a three-level transmission chain that has been locking gold in a cage. Look at the numbers. The April headline CPI came in at 3.8%, while the core CPI, which strips out food and energy, sits at 2.4%. That massive gap is entirely fueled by oil prices. We watched the tension in the Strait of Hormuz send Brent crude above $105 for weeks, and that oil price increase acted like a thick winter coat that covered up the real economic temperature. When the market sees that 3.8% number, they instantly react with fear. They think the Fed cannot cut rates. They think inflation is out of control. And they start pricing in more hikes. That is the first level of the trap. Oil prices create a fake inflation narrative, which triggers the second level because gold is an asset that pays you nothing. It does not give you dividends, it does not give you interest. So when US Treasury yields are climbing and you can earn over 5% just by sitting in a cash account, the opportunity cost of holding gold becomes too expensive for institutional capital. They pull their money out of gold and move it into yield-bearing assets, and that leads to the third level, the resulting price stagnation that we have all been suffering through. So now let us look at the ceasefire. The common consensus is that if the war ends, the fear vanishes and gold crashes, but that logic is fundamentally broken because it assumes that geopolitical fear was the primary engine of the gold price. It was not. The real engine was that three-level transmission chain. So if the ceasefire actually happens, it is not bearish for gold, it is the exact opposite. It is the key that unlocks the three biggest doors. The first door is the oil market. If the Strait of Hormuz is truly open for business, that massive war premium on every barrel of oil has to be priced out. As that premium disappears, the downward pressure on oil prices becomes a trend. And the second door is the headline CPI. If oil prices drop by even 15%, the headline inflation number will naturally drift downward and start closing the gap toward that 2.4% core rate. Once that headline number cools off, the market panic over interest rate hikes will lose its data-driven foundation, which leads to the third door, the interest rate environment. Once the narrative shifts from hiking to potential easing, the opportunity cost of holding gold begins to collapse, which allows capital to rotate back into non-yielding assets. It is a perfect storm for a sustained rally, and it is exactly why the crowd is currently holding the wrong end of the stick. They are focusing on the surface level narrative while ignoring the deeper structural shift. And we have to talk about the new leadership at the Federal Reserve, specifically the transition to the new chair whose framework focuses on average inflation rather than reacting to monthly noise. This is the most underrated card in the deck, because it means that even if a single month of data looks hot, it does not necessarily mean the long-term policy goal is changing. Yet the market has not fully digested this yet. They are still trading as if every single headline is a catastrophe, and that disconnect is exactly where the alpha is found. Now we have to talk about Thursday. The PCE release is going to be the biggest volatility catalyst of the quarter. And I want you to understand why this matters more than any other report. CPI is like a rigid basket of goods that assumes people never change their habits. But PCE is dynamic. It follows how consumers actually respond to rising prices. It is the thermometer that the Fed actually uses to judge the health of the economy. If the PCE print comes in hot, the market is going to freak out. You will see a temporary spike in yields and likely a sell-off in gold. But I want you to be ready for it, because that sell-off will likely be a buying opportunity. Think about the lag. The PCE data is looking at what happened in the past. It is still absorbing the shock of the oil spikes we saw last month. If the ceasefire is already underway, you are looking at data that describes a reality, which is already in the process of disappearing. So when the headlines say inflation is hot, remember that you are looking at a rear-view mirror. The real trend is the normalization of energy costs. And that is why you need a concrete plan. If the PCE is high and the ceasefire fails, you play defense. You hold what you have and you wait for the fog to clear. If the PCE is high but the ceasefire holds, you look for the divergence. You see the sell-off not as a failure of your thesis but as a final shake. Out before the real trend begins. And if the PCE is cool and the ceasefire holds, you have the most powerful catalyst for a trend reversal we have seen all year. And that is where you really need to be focused. We are talking about a systemic shift. And the reason I keep emphasizing the long term is because of the US debt situation. Look at the 30-year Treasury yield. It is sitting over 5%. That is not sustainable. The government is essentially trapped in a cycle of rolling over debt at increasingly painful interest rates, and that creates a fiscal burden that will eventually force the hand of any administration. Regardless of their political rhetoric, that is why gold is ultimately a bet against the long-term integrity of the fiat system, because when you have this much debt and this much pressure on the interest rate environment, the only way out is to let the currency devalue. And that is exactly why you hold gold. It is the only asset that does not rely on a central bank promise to have value. I know the market is trying to scare you. I know it feels like the charts are telling you to run, but if you have followed my logic this far, you know that the short-term volatility is just noise designed to shake out the weak hands. You have to be the one who looks past the headline. You have to be the one who tracks the transmission of energy costs into the inflation data. And you have to be the one who realizes that a ceasefire is not the end of the gold story, but rather the beginning of the next chapter. Remember that the best investment results rarely come from reacting to the news everyone else is reading. They come from positioning yourself for the trend that everyone else is too afraid to see. Keep your discipline. Watch the oil price. Watch the PCE reaction. And do not let the market dictate your conviction. Because when the dust finally settles and the interest rate narrative shifts back to reality, those who stood their ground are going to be the ones rewarded. It is not about guessing the number. It is about having an action plan for every scenario. And if you are still feeling uncertain, just remember that the fundamentals of this macro cycle are shifting in favor of those who can wait. The noise is just a test. And if you can keep your head while everyone else is panicking, you have already won half the battle. Stay focused on the variables that actually drive the price. And remember that gold is not just an asset. It is your insurance against the very systemic instability that everyone else is currently ignoring. Keep your strategy simple, your risk managed, and your eyes on the long term. Because this is the decade where discipline truly separates the amateurs from the professionals, and I promise you that when we look back at this week, it will be the moment that defined the trajectory of the gold market for the next few years. So do not let them take your chips, hold your position, trust the process, and prepare for the volatility ahead, because it is only in the face of this kind of chaos that true opportunity reveals itself to those who are patient enough to wait for the signal. Keep tracking the data, keep refining your logic, and I will see you in the next one as we continue to break down the real rules of the market.